In this video, we will be talking about the 3 steps you need to do before buying your first investment property. Investing in real estate can seem intimidating and daunting. With all the real estate concepts and jargon out there, it is easy to get confused and exasperated as an aspiring investor. That is why, before you buy your first investment property, you should make the necessary preparations both emotionally and mentally. Real estate investing can become much easier if you're able to cultivate the right attitude and learn the right metrics to look out for. Always keep in mind that in order for you to have success in real estate investing, you don't have to know those scary looking formulas or computations. As long as you know the basics and the fundamental concepts that matter, you can be able to run a successful real estate business. Just like in driving a car, you don't have to memorize and know the function of each part to drive it, right? Now, without further ado, here are the 3 steps you need to do before buying your first investment property. Number 1, get into the proper mindset. Before you go out into the world and start acting like a real estate investor, you should see to it first that internally, you are already one. So before you get fixated about the entire investor image, you should first commit internally in becoming a real estate investor. This means that you have to adopt a mindset that sees the gold mine of opportunities rather than the bleak limitations in the world around you. This mindset reframes the pessimistic, "there's no way I can do this" way of thinking to "what do I need to do to get this done" mentality. To be successful in real estate investing, you need to commit to this mindset, at least for the most part. And just in case you haven't heard, commitment is when you decide to do or pursue something and continue doing it even through the bad times and challenging situations. Because let me tell you, whether you're going to be flipping houses or renting out properties, you will run into all sorts of trouble. You will experience getting into bad deals or working with unreliable and shady contractors or dealing with difficult tenants. So, contrary to what everybody wants you to believe, real estate investing is by no means purely passive. Now, let's go back to commitment for a bit. If you are committed to doing something, the motivation to pursue it should be based on something more deep and profound than fleeting emotions. In other words, this motivation which propels and underlies your commitment must be fueled by an all-consuming desire. For the purpose of this video, what we want to achieve here is for you to think about real estate investing as a means to an end. That is, an end which you strongly desire to pursue. So, you should ask yourself the question, why am I investing in real estate? Although there is no one-size-fits-all answer to this, it would be a good sign if your answer isn't money itself. Perhaps you have an all-consuming desire to gain financial freedom and spend more time with your loved ones or kids or family. Or maybe you're dying to escape the dreadful 9-to-5 job. Maybe you want to escape your awful boss and be your own boss. Or maybe you're just sick of partaking in the usual workplace politics with your phony co-workers. But simply put, this desire should relate to your ideal life. But whatever this desire is, you have to want it bad. I mean really bad. One way of strengthening your desire to reach a certain goal in real estate investing is by visualization. You can do this by writing down on paper and describing your ideal life with as much details as you can and reading it, preferably once in the morning and once before sleeping. When you are reading the details of your ideal life, it helps if you vividly imagine this, as this can help stoke your desire even more. Another way of building up your desire for your real estate goal is by spending time with the people who share a similar goal and who have more experience than you in real estate investing. The more time you spend with these people, the more you will be influenced by their values and mindset and make them your own. Plus, you will certainly gain more knowledge about real estate investing by hanging out with people who are further along in the game. Not to mention, you could meet someone who could be a mentor to you. Number 2, educate yourself. Now that you've decided to become a real estate investor and have the proper mindset, it is now time for you to educate yourself on the basics of real estate investing. However, you can't just go and read every book you see about real estate. Instead, it would help you greatly if you already decide on a niche before you start learning the basics. So, you need to pick a specific area of real estate investing and begin your education from there. For example, you should ask yourself, which interests me more, residential real estate or commercial real estate? If you chose residential, then ask yourself again, will I focus on house flipping or rental investing? On the other hand, if you chose commercial real estate, which means that you will most likely be looking for a rental property, then you have to ask yourself again, should I buy a multifamily property or should I rent out retail or office spaces? And so on. Then after you've decided on where to start, then it's time for you to begin learning. You can start from the following sources. YouTube. Clearly, you're already onto this one. In YouTube, you can find tons of educational and how-to videos about real property investing. For those of you who are more inclined to residential real estate investing, you can check out videos from the Bigger Pockets channel. This channel produces videos which tackle every aspect of residential real estate investing, from choosing the right property to buy to tips on dealing with difficult tenants. For those interested in commercial real estate, it is highly recommended that you watch videos from Tyler Cobble's channel. The scope of his videos is expansive and deals with the nitty-gritty of commercial real estate investing. Also, if you haven't noticed by now, YouTube is a repository for many free audiobooks about real estate investing, and they're all just waiting for you to listen to. Books. This one is self-explanatory. You can go to your nearest bookstore right now and find a book about rental property investing. If not, you can easily buy one online or you can even download an audiobook. If you're opting to go for audiobooks, then it is highly suggested that you subscribe to Audible, which should cost a little over 800 pesos per month. But with that fee, Audible gives you a monthly credit which allows you to download one audiobook every month. Although there are many books to choose from when it comes to real estate investing, the recommended books for real estate investing beginners are Brandon Turner's The Book on Rental Property Investing and Gary Keller's The Millionaire Real Estate Investor. These books do a great job of introducing the reader or listener to the world of real estate investing at a pace that is well suited for a beginner. However, the book on rental property investing is more comprehensive as it deals in more detail with the everyday realities of real estate investing, such as managing and maintaining your rental property and managing your tenants. On the other hand, The Millionaire Real Estate Investor is a more ideal book for someone wanting to achieve the investor mindset, since it guides the reader or listener in dispelling the real estate investing myths which usually hold back aspiring real estate investors from starting their investing journey. For those aspiring to be commercial real estate investors, you definitely can learn a thing or two from Brian Murray's Crushing It in Apartments and Commercial Real Estate. In this book, Murray talks about the importance of minimizing unnecessary spending or bootstrapping, picking the right commercial real estate niche, running your commercial rental property as a business, and etc. And he does it in a way that makes it easy for real estate beginners and novices to grasp otherwise complicated real estate concepts. Podcasts. Another great way of taking in your real estate knowledge is through podcasts. Podcasts are unique since they make you feel like a fly on the wall listening to real estate experts casually conversing about different topics. And just like with audiobooks, you can easily listen to podcasts even when you're on the go. You can listen to one while you're driving, preparing dinner, commuting to work, or even when you're just by yourself with nothing to do. Among the numerous real estate investing podcasts you can check out are Real Wealth Show, Real Estate Investing Podcast, the Bigger Pockets Real Estate Podcast, the Real Estate Guys Radio Show, and the Best Real Estate Investing Advice Ever Show. When learning from all these sources, it is important to keep in mind the important real estate concepts that will either make or break your prospective real estate business. Meaning to say, there are concepts that you have to learn by heart and look out for in order to know if you're going to make a profit from your real estate venture or not. The examples of such concepts are fair market value of properties. This is important since real estate investors are always looking to buy properties, either for flipping or as a rental, at a discount. Usually, it is advised that you should be able to negotiate the price of the property you want to buy, which is usually pegged around at the fair market value, and acquire the same at a 20% to 25% discount. In that way, you are already guaranteed of making a profit upon purchasing the property. However, it is not always easy to measure the fair market values of real properties, especially since these vary between geographical areas. But a quick way for you to gain familiarity fast with the fair market values that matter is to make it a habit on your part to look at property listings in the area you plan to invest in and which are similar to the ones you plan to have as an investment. Fair market rent. For those seeking to be rental property investors, knowing the fair market rent in your area and niche is extremely important. In rental property investing, always remember that cash is king and you will need lots of cash in order to carry on your business and expand. But remember that you can only get cash from tenants, and you can get tenants quicker if you rent out your property at a price that prospective tenants are willing to pay. To have an idea about the fair market rent in your area and niche, you can check out real estate listing websites such as Lamudi and Property to see how much other landlords in your area with similar properties are charging for rent. After you get an idea of the fair market rent, the smarter strategy is always to price your rent slightly lower than the fair market rent in order to make your offer more attractive. Always remember that in order to last long as a real property investor, you should not be greedy, or else you will see a number of your units remain vacant for a long period of time. To make this point more vivid, just imagine which of the following scenarios would you prefer to find yourself in. Renting out your property for the maximum price for only a couple of months in a year, or renting out the same property at a cheaper price for years and years. Obviously, renting your units at a cheaper price will make the vacancies least likely to occur and put more money in your pocket. Net operating income. After you have an idea of the fair market rent of the rental property you plan to purchase, you can now be able to do some computations regarding the possible gross rental income that property would be able to produce once rented out. Now, you can't run your rental property business without incurring expenses, right? So it is quite unavoidable for you to have utility expenses, taxes, and other recurring monthly expenses. If you get the total of these monthly recurring expenses and subtract it from your gross monthly income, you will be able to arrive at your monthly net operating income, or NOI. Always keep in mind that in computing for your NOI, you should not include your monthly amortization if ever you used financing in acquiring your rental property. This is because monthly payments to a lender tend to vary owing to the uniqueness of each transaction wherein real estate is acquired, and your property's NOI has to be fixed since it is often used as a basis in determining either your property's capitalization rate or the property's market value. We will tackle the concept of capitalization rate in later videos. But for now, let's keep things simple. Thus, as mentioned, your annual NOI dictates your property's market value, and the equation for a property's market value is equals NOI divided by capitalization rate, which is a certain percentage. Capitalization rates vary between geographic areas and different kinds of rental properties. Cash flow. If you further subtracted your monthly mortgage payments from the NOI, you will get your cash flow. This is now your profit, plain and simple. From such figure, you can now compute your cash-on-cash return on investment, or your COC ROI. The COC ROI of your rental property can be computed by dividing the annual cash flow with the amount of cash you spent in acquiring the property. So for example, if your property earns a cash flow of 500,000 pesos every year, and your whole cash outlay in purchasing that property is 1 million pesos, then that property is able to fetch you a COC ROI of 50%. The COC ROI is useful in order to compare your real estate investment yield with other investment vehicles such as stocks or bonds. Number 3. Chart your path. Know where you want to eventually end up business-wise and know the steps you have to take in order to get there. This is important so you won't get sidetracked from deals or transactions that do not bring you any nearer to your ultimate business goal. In order for you to chart your path in real estate investing, and assuming you've already, to some extent, decided on which type of property you will be investing in, it's time for you to put your plan on paper. In the second step, we talked about determining what specific kind of property you'll be purchasing when you begin. So, if you previously decided to invest in residential real estate, then now you should decide what kind of residential real estate. Will you be buying single-family homes, duplexes, or triplexes? But this time, while you're deciding the specific kind of property you should choose, you should also bear in mind your potential market, especially if you're planning to rent out such property. So, for example, if you're planning to buy a single-family home rental property near offices of BPOs, then you could renovate the property in such a way that will attract BPO employees. You could renovate and convert that single-family home into a boarding house and rent it out to different tenants. After you've decided on the specific kind of investment property you will be buying, you then have to plan your buying frequency. Should you buy every 3 years, every other year, or every year? You should also try to plan and foresee if ever you will eventually be buying or trading up to bigger properties. Finally, it would definitely be beneficial for you to give yourself some kind of a deadline with regard to how many years it will take for you to accomplish your ultimate goal. And obviously, at such time, you should already have an idea as to how many rental properties you'll be ending up with as you reach your ultimate goal. However, if you ever get tired of managing your rental assets, then there's definitely nothing wrong if you sell all of them. This kind of exit strategy has been adopted by a number of rental property investors. Once you have all of these things in writing, you now have your plan. It helps if you consult your plan every now and then in order to determine the next thing you should do that will bring you closer to your next goalpost or milestone. As much as possible, you should try to stick to your plan and do only the things that will bring you closer to your ultimate goal. However, digressing from time to time is acceptable, considering that unforeseen things and circumstances will always arise that will force us to adjust as to our plans. So, there you have it, the 3 steps which you should do before buying your first investment property. Do all these steps and you will be able to cope better with the unavoidable realities of real estate investing. Thank you for watching. Please leave your comments down below and don't forget to subscribe.